Hey everyone, welcome back to Corporate Decoder, the place where we unravel the secrets hidden within corporate filings. And let's just say Parks, America Incorporated's latest report is full of more surprises than a petting zoo. This is a quarterly report from Parks, America Incorporated, and it is like a peek behind the curtain of their business for the period ending the 28th of December 2025. Normally these reports can be drier than a popcorn fart, but we are going to find the juicy bits. Let's kick things off by looking at their balance sheet. Think of this as a snapshot of what the company owns and what it owes at a specific moment. On the 28th of December 2025, Parks America Incorporated had about $19.2 million in total assets. That sounds like a lot, but remember, companies have assets like buildings and equipment which are worth a lot, but don't necessarily mean they have tons of cash lying around. Speaking of cash, they had about $3.4 million in cash and cash equivalents. That is down a bit from nearly $3.9 million at the end of September. Not a huge drop, but something to keep an eye on. Their property and equipment is valued at about $15.1 million. This makes sense for a company that owns and operates safari parks. They have land, buildings, animal shelters, and all sorts of stuff to keep those animals happy. Now let's look at what they owe. They had about $101,000 in accounts payable, meaning money they owe to their suppliers. This is pretty standard. But then there is other current liabilities which stands at almost $500,000. This category can be a bit of a black box, but it's important to note that it's a significant chunk of their short-term obligations. Their long-term debt is around $2.7 million. This is the money they owe that is due in more than a year. It is not sky high, but it is a noticeable amount for a company of this size. All in all, the company's total liabilities were just under $4 million. Their total stockholders' equity was a much larger, almost $15.2 million. This means that if you were to sell off all their assets and pay off all their debts, the owners would still have a pretty good chunk of money left over. Now let's dive into the statement of operations. This is where we see how much money they made and what they spent money on. For the 3 months ending the 28th of December 2025, they brought in about $2.1 million in total revenue. That is a nice increase from about $1.77 million in the same period last year. The vast majority of that revenue, about $2.07 million, came from park revenue. This shows the core of their business is indeed their parks. Interestingly, they also made some money selling animals, about $19,000 in this quarter. This is down from about $51,000 last year. I guess the animal breeding program had a bit of a slow quarter for sales. But here is where things get interesting. While their revenue went up, their selling, general, and administrative expenses also went up significantly. These costs were about $1.6 million in this quarter, up from $1.55 million last year. This shows that running the business and marketing, it is a huge expense for them. And look at this, there are contested proxy and related matters with a value of 0 this year, but a whopping negative $567,000 last year. This probably relates to some shareholder drama that thankfully seems to be resolved. And the bottom line for this quarter, they reported a net loss of about $36,000. That might sound bad, but it is actually a lot better than the net income of $193,000 they had in the same period last year. This contrast is really what makes studying these reports so interesting. The weighted average shares outstanding were about 753,000 this year, and slightly more at 757,000 last year. This is important because it affects earnings per S-share. Looking at the statement of changes in stockholders' equity, we can see how the owner's stake in the company has changed. At the end of September 2025, the company had about $15.26 million in stockholders' equity. By the end of December 2025, that was down slightly to about $15.23 million. This is directly related to the net loss we just saw. Let's talk about cash flows. This report tells us where the company's cash came from and where it went. They used about $56,000 in operating activities. This means their day-to-day business operations consumed more cash than they generated this quarter. In investing activities, they spent about $304,000 on acquiring property and equipment. This is something a growing company does to improve its facilities. And in financing activities, they paid off about $97,000 in loans. It is good they are reducing their debt. Last year, they had some much larger financing activities, including paying off a 2020 term loan and taking on new ones. This shows them actively managing their debt. Now we get to the really detailed part, the notes to the financial statements. This is where they explain all those numbers in more detail and introduce you to terms you might not know. Here they tell us about their accounting policies, like how they handle revenue recognition. They recognize park admission revenue when customers get access to the park. They also defer revenue for things like season passes and advance online tickets until the customer actually uses them. This is pretty standard practice for businesses with recurring services like this. Their fiscal year ends on the Sunday closest to the 30th of September. This helps them align their financial reporting with the busy seasons of their parks. And they explicitly mention seasonality. Their parks are open year-round, but they make a lot more money in the warmer months. They get about 64% of their annual park revenue in the third and fourth fiscal quarters. This is a critical insight for understanding their financial ups and downs. This note talks about a reverse forward stock split that happened in April 2025. Essentially, they did a reverse split to reduce the number of shareholders and then a forward split. This is often done to make the stock price look more attractive or manageable. All their past figures have been adjusted to reflect this. In the property and equipment section, we see a breakdown of their assets. They have land valued at over $6 million mineral rights, about $276,000 and ground improvements, like paths and landscaping worth over $3.5 million. Their buildings and structures are valued at over $5 million and animal shelters and habitats at about $3.7 million. This is where the money really is for running a zoo-like operation. They also list park animals at over $1.1 million. It's good to see they are valuing them. Looking at the detailed schedule of property, plant, and equipment, we see the depreciable lives. For example, buildings and structures have lives ranging from 10 to 39 years, and park animals from 5 to 25 years. This gives us an idea of how quickly they expect these assets to wear out. Intangible assets include things like their website domains and trade name registrations, totaling about $20,000. These are assets that don't have a physical form but still hold value. They discuss fair value, which is what an asset is worth in an orderly sale. They mention their long-term debt has a fair value of about $3.15 million. This is slightly higher than its book value, meaning people might be willing to pay a bit more for that debt than its current recorded value. And under other current liabilities, we see a breakdown of accrued professional fees, deferred revenue, as well as accrued compensation and taxes. Deferred revenue of $52,000 means they collected money for services not yet rendered. Revenue recognition is crucial. They recognize park admission fees when folks enter the park, but season pass revenue is spread out over time. They also changed their policy in January 2026 to ensure advance online tickets are used by a specific date. This is a smart move to better manage expectations and revenue timing. This note details a proxy fight. It sounds like a big shareholder group tried to take control by electing their own board members. In the end, they got some directors elected, but not a full takeover. They also received $567,000 in insurance money related to this conflict. This shows that even seemingly stable companies can have internal battles. Here we get the details on their loans. They have a 2021 term loan with Synovus Bank for about $760,000 outstanding. They also have a 2025 term loan with Sendera Bank for roughly $2.39 million. This 2025 loan is interesting because it is secured by almost all the assets of one of their subsidiaries, and there is a $2.5 million cash collateral reserve, put up by Focused Compounding Fund. LP, this Focused Compounding outfit, is controlled by two of their board members, Jeffrey Gannon and Andrew Kuhn, who also happens to be their president. This is a classic example of related party financing, which can be a double-edged sword. The total outstanding long-term debt as of the 28th of December 2025 was around $3.14 million. Thankfully, this is down from over $3.24 million at the end of September. This note explains that stock split. They did a 1 for 500 reverse split, followed by a 5 for 1 forward split. The goal was to reduce administrative costs from having too many small shareholders. All the previous numbers have been adjusted to reflect this. They announced a share repurchase program in December 2025, allowing them to buy back up to 75,000 shares or $3 million worth of stock. This is usually a sign that management believes the stock is undervalued and a way to return value to shareholders. However, they did not repurchase any shares in this quarter. This section breaks down their operations by park: Georgia Park, Missouri Park, and Texas Park. Management evaluates performance on a park-by-park basis. Looking at the revenue by segment for the 13 weeks ending the 28th of December 2025, the Georgia Park brought in the most revenue at over $1.18 million. Texas Park followed with over $553,000 and Missouri Park with around $357,000. The Georgia Park was profitable with over $311,000 in segment income. Texas Park also showed profit at over $129,000. Unfortunately, the Missouri Park reported a loss of over $33,000. This tells us that not all parts of the business are performing equally well. This reconciliation shows how segment income relates to the overall income before taxes. They have unallocated corporate expenses that are not tied to any specific park. These were over $218,000 in this quarter. Now we get to the management's own take on things. They explain their business and highlight key trends. They state that total revenue was $2.09 million in this quarter, up 18.2% from last year. This is a positive sign. Park revenue specifically was up a solid 20.7%. This is great news for their core business. The Georgia Park saw an 8.1% increase in revenue thanks to better weather and more in-park spending. The Missouri Park showed a strong 29.5% revenue increase, partly due to a new capybara encounter and a new animal encounter building. This shows they are investing in new attractions to draw in customers. And the Texas Park had a massive 51.5% revenue jump. This is attributed to more favorable weather and successful marketing strategies. Attendance at the Georgia Park was up 16.7% and at the Missouri Park by 21.4%. These are strong indicators of growing customer interest. They noted that the Texas Park's attendance comparison might be skewed due to free promotions last year. Their advertising and marketing expenses significantly increased this quarter to over $242,000 compared to $123,000 last year. This is likely due to a new advertising agency and a shift in strategy towards digital marketing. It is a big expense, but hopefully it pays off in increased revenue. The consolidated segment income rose by a healthy 75.2%. This is a direct result of the revenue growth and improved operational efficiency in some parks. Corporate expenses decreased by about $52,000 compared to last year. This is good to see some cost control at the parent company level. Depreciation and amortization expenses were slightly up at $211,000. This is expected as they invest in property and equipment. And the big reveal, a net loss of $36,000 for the quarter. While it is a loss, it is a significant improvement from the net income last year. This is a key point of analysis. They are losing less money while growing revenue, which is generally a good sign. They discuss non-GAAP measures like adjusted net income and adjusted EBITDA. These are ways to look at profitability, excluding certain one-off or non-operational items. They use adjusted EBITDA to compare performance across different periods without the noise of things like proxy fights. For this quarter, adjusted EBITDA was $211,000. Last year, they had a negative adjusted EBITDA of about $24,000. This shows a significant improvement in their core operational profitability when you strip away the extraordinary items. They talk about their financial condition and ability to meet their obligations. They have enough cash and credit lines to operate smoothly, especially given the seasonal nature of their business. Their working capital decreased slightly, but their debt-to-equity ratio remains healthy at 0.2 to 1.0. This means they owe much less than their owners have invested, which is a sign of financial stability. Net cash used in operating activities was a modest $56,000. This negative cash flow from operations highlights their seasonal dependence and the need to manage cash carefully. Investing activities show a net cash outflow of over $300,000. This is for capital spending on property and equipment, which is a necessary investment for growth. Financing activities show cash being used to pay down loans. They are actively managing their debt, which is a positive sign of financial discipline. And for those of you who love the nitty-gritty, they didn't repurchase any shares of their common stock, even though they had a plan in place. Now, for my take on all this, parks, America Incorporated is definitely showing signs of life. Their revenue is growing strongly and their parks are attracting more visitors. The improvements in Georgia and Texas are particularly encouraging. The fact that they are reducing their net loss even while spending more on marketing and investing in their parks is a big positive. However, the volatility around the contested proxy matters and the reliance on related party financing for the 2025 term loan are areas to watch. They are also heavily seasonal, so we must remember that the first quarter is typically their weakest. Overall, the company seems to be on an upward trajectory with a clear strategy to grow revenue and improve profitability. It's not a guaranteed success story yet, but the pieces are starting to fall into place. What do you think? Are these parks on a fast track to recovery, or are there hidden costs we should be worried about? Let me know your thoughts in the comments below. If you found this breakdown helpful, please give it a thumbs up and subscribe for more deep dives into corporate filings. And don't forget to join our growing community on Discord. The link is in the description. Thanks for watching, and we will see you on the next one.